Are you feeling the pressure as stock prices continue to fall? Are you wondering why the markets are in free fall? Well, buckle up, because in today's video, we're breaking down the real reasons behind the recent crash and what this could mean for you as an investor. You're not going to want to miss a second of this, because understanding what's happening now can help you navigate these choppy waters and even come out stronger. Let's get started. First things first. What's happening on the ground? Indian stocks are on a downward spiral, with Nifty 50 and Sensex dropping over 0.80%, hitting their lowest levels since mid-August. In just the last few days, the Nifty 50 has corrected nearly 7%, and the Sensex has fallen by close to 6%. Both indices are posting their worst weekly performance in 2 years. But why, after such a strong year, are we suddenly seeing this sharp decline? The short answer? Global geopolitical tensions. Let me paint you a picture. A growing conflict is brewing in the Middle East, specifically between Israel and Iran. Tensions are running high after Israel's potential plans to attack Iran's oil and nuclear facilities came to light. Now you might be wondering, what does this have to do with the Indian stock market? A lot. You see, Iran is a major oil producer, contributing around 3% of global oil output. So, any attack on its oil facilities could trigger a massive spike in crude oil prices, which, in turn, would hit countries like India hard. Higher oil prices impact everything from aviation to automobiles, paints, and chemicals. The costs for companies in these industries will soar, and that's why we're already seeing their stock prices nosedive. But that's not the only storm cloud hanging over the market. The foreign portfolio investors, or FPIs, have pressed the exit button on Indian stocks, and fast. In the first 3 days of October alone, they pulled out a whopping 30,719 crore rupees. In fact, on October 4th, FPIs offloaded 15,506 crore rupees worth of equities, marking one of the sharpest sell-offs in recent history. The big question is, why? Well, they're redirecting their investments to China and Hong Kong, where fresh policy measures from Beijing are sparking optimism about a recovery in their economy. Chinese stocks are now looking far more attractive, with the Shanghai Composite Index surging by 17.4% and the Hang Seng Index rocketing by over 32% in just a month. Indian stocks, on the other hand, are seen as overvalued compared to these markets, pushing foreign investors to move out. And if the global tensions weren't enough, the rise in crude oil prices is adding even more fuel to the fire. Higher oil prices hit multiple industries hard, especially in a country like India that relies heavily on oil imports. From aviation to automotive, paints and textiles, higher costs mean shrinking profits, which is why stocks in these sectors are taking a beating. And as crude oil prices continue to climb, the pressure on the market is only going to increase. To make matters more complicated, central banks around the world are now facing a dilemma. Just last month, things were looking better. The US Federal Reserve cut rates by 50 basis points, and China rolled out stimulus measures that had markets rallying. But with the ongoing conflicts and rising oil prices, there's a growing concern that major central banks might rethink their approach to further rate cuts, which could slow down economic recovery. And we all know how closely linked central bank decisions are to market performance. So, is this crash just the beginning of a bigger correction, or is the worst behind us? The initial turmoil caused by Russia-Ukraine and Israel-Hamas conflicts has persisted without causing long-term market disruptions. We could see a similar scenario with the Israel-Iran tensions. Historically, the Indian market has proven resilient in times of geopolitical uncertainty. But as long as these conflicts remain unresolved, expect the market to remain volatile. Pause for effect. However, don't lose hope. Every time foreign investors exit, domestic institutional investors, DIIs, and retail investors have stepped in to stabilize the market. This is why we see Indian markets bounce back time and time again. So while there may be short-term pain, there's always a silver lining for long-term investors. All right, so what's the takeaway from all of this? The market is facing a lot of pressure from geopolitical conflicts, rising oil prices, and foreign investor exits. But, as we've seen in the past, the Indian market is resilient. Long-term investors who stay patient and focused on fundamentals often come out on top. So, stay informed, stay cautious, and use these dips as opportunities to strengthen your portfolio. pause for final impact. If you found this breakdown helpful, hit the like button, share this video with your friends, and make sure you're subscribed to the channel for more timely updates and insights. We'll continue to track these developments closely. Until next time, stay sharp and invest smart.